Welcome back to episode 4 of Real As It Gets, Gord.
How are you today, Trevor?
Gordo, there was a little bit of thawing, right? The weather's getting a little bit nicer after family day. And I was telling you in Peel, our property taxes go towards plowing the sidewalks, but the tractor they bought is bigger than the freaking sidewalk. So it takes up all the grass while it does it.
It messes up the lawn.
But then it freezes over. So then you got these speed bumps on your driveway. So anyways, long story short, I was trying to get those off. And it probably wasn't as thaw as I should have maybe done it. And I pulled my back.
Nice.
Like bad. Like I might do the little,
So that's why I had to move all the chairs.
Yeah, that's how you did everything today. Yeah. Well, you're the young buck anyway.
Of course. Yeah. It'll get better, Trevor. You just got to keep working out.
That's what they say, right? Yeah. I got to do some more mobility, some stretching. There you go. Feel young and limber. What's going on with you?
Go to pickleball. You'll feel great.
Yeah, I played that with my aunt and uncle who's, I think, your age, right? We're 70s or what?
Yeah, something like that.
What's going on with you? Anything new? Anything exciting?
Nothing really new. Today we're talking about mortgages, though.
Are we talking about mortgages?
We are. We get asked a lot about how to get pre-approved. In fact, you were looking on Google.
We had this list, right? We're like, how should we keep things rolling? And sure enough, Google and chat said the number one search right now is how to get a mortgage, which I think if the silver lining there too is people are thinking about at least affordability for homes.
That's right. So there might be some kind of light at the end of the tunnel for this market where people are thinking about getting back in. I think part of it is because maybe interest rates are going to be stable for a while. So people are, maybe saying maybe now's the time, like maybe don't want to wait any longer. And, they've waited long enough and it's time to get moving.
Yeah. So we're going to get into that. Before we do, quickly, I just want to, you watch the Olympics at all, Gord?
I do watch the Olympics.
Yeah. It's been pretty good, eh?
It's amazing.
Canada's starting to pick it up. I was a little worried at the beginning. Yeah. But we're cooking now.
And we got the
big air
women's hockey team. Super looking forward to those games. So
yeah, Poulin, she passed Haley Wickenheiser.
20 goals.
Yeah, it's crazy.
It's amazing. Crosby's got 15.
Yeah, I saw 15 points or goals.
I think it's
he's
goals.
The most something.
I think it's got to be goals.
That's crazy.
Yeah.
Well, I'm excited, and the women I think are going to be in tough, but the boys I hope can actually both. It's going to be a battle.
It's going to be a battle. It's going to be, I think, just like one of those epic games. Like we'll be talking about
both of them. Yeah,
both of them. We'll be talking about for a long time.
I'm excited. All right, well,
to go.
Go, girl! Yeah, come away, eh? Okay, so what are we getting into? We're going to talk about mortgages. I guess let's kind of do like a high overview. Maybe break it down from the basic standpoint, so people really. I guess if you're a first-time buyer, you might not even know.
You might not. One of the things they don't teach you in school is mortgages and lending. And I think it should be a prerequisite subject.
It's such a dad thing to say.
But it's true. They don't teach anything about it.
At home, I'm like, why do I need to learn about calculus when you could learn about mortgages, credit, budgeting, real-life things? I still don't know how to solve for pi or whatever it is.
I know. You can calculate the volume of a pile of dirt, but you can't figure out what a mortgage is going to be.
It's crazy. Mm-hmm. And to each his own, right? Obviously, if you're going to a specialty, you got to learn certain elements of math. But these are life skills, exactly. Yeah. Okay, so let's start at the beginning. Why do we get pre-approved, and what does that look like? You want to start it off?
Well, yeah. So pre-approval, really, I guess that in a nutshell, is just how much you can afford, or how much the bank is willing to lend you to purchase a home, and it's qualified many different ways, I guess. But I guess the overall picture is, how much is the bank willing to lend you? So you can purchase a home.
And that looks like you're going to be giving your NOAs likely 2 years, T4s likely 2 years. They look at your debt and making sure
credit score.
They look at your credit score.
Another thing that a lot of people aren't aware of, what a credit score is. What a good credit score, what's the benchmark.
And we were talking, I think 2 weeks ago, me and my buddies, remember when you would go to the Blue Jays game and you could sign up for...
when it was $2 a ticket?
Back when it was $2 a ticket.
At the grandstand? Yeah, I remember that. Do you remember that?
I don't know if I was born when it was hey, Gord? No, but when you would get the free t-shirt, right? And you just had to sign up for a free mascot or whatever.
Right.
And people would... activate it, just thinking I won't use it. But that was constantly like doing a soft check on your credit. You put, X amount of money on it, you forget about it, and now it's hurting your credit all for a little, t-shirt, right? So I think to your point of like credit cards in general and building credit, because it's not just taking a credit card, spending money and paying it off, but like other elements too, from like a home and utilities and Rogers and car payments, et cetera, right?
All that gets factored into your credit score. But to your point, having a credit card and paying that credit card off monthly and having a balance is good for your credits.
Exactly. Yeah.
Not paying it off or being delinquent on it is not good it's bad for your credit score.
We have friends that will only spend money on their debit. And I'm just like, why? Because one, you get the month luxury of paying what you need. I get it. If you're the type of person maybe that you spend out of your means and you want to make sure you're keeping it to what you can actually afford, fine. But like, I don't know, the travel visas, the cashback visas, the points and things you can earn. Like we go on a trip usually once a year just because of our visa of spending on what we would spend anyways, right? So, and then you were talking about thresholds though too, right? Like what it actually looks like from a high credit score, which I think is about 700, 720 and up, or 740.
Yeah, over 700, and like different banks are going to have different thresholds with like, where you're approved or what you're approved to. But generally speaking, I think 700, you're starting to be in the realm of, you've got a good credit score.
And that's where you want to be.
And that's where you want to be.
And then, okay, so we're talking getting pre-approved. So we've gone to a bank or a mortgage lender. We've given our statements, what debt we have, and they've built out, okay, based on X, Y, and Z, here's what you can afford.
Right. And so when you talk about what debt you have, they're looking for all the debt. So do you have a student loan? Do you have credit card debt? Do you have
you can't lie.
Payments? You can't lie. They will find that information.
Well, even if you do lie and then you get to the table and the information you gave was incorrect, now you're in trouble. So don't lie. No pre-approval.
Yeah, so they take all that information and employment letter. So you have to prove that you're employed. And then from my understanding, like having an employment the same job for more than 2 years is really good for approval. They're looking for consistency.
Everything is minimum 2 years from what I remember.
And they're looking, they want to know that you can pay it back. That's what they're looking for.
Perfect. Okay, so we're getting pre-approved now. Are you locking in your rate at that time? Are you just getting a number that is, here you go, here's $2 million, Gord, go run and buy whatever you want? Because I always like to talk about getting pre-approved of you've done your due diligence from the lender qualifies you, but then there's the affordability of can you carry this home, right?
Correct.
Because you may get approved for $2 million, but $2 million on whatever amount you're putting down could be, $10,000 on a mortgage payment before you've sniffed turning on a light in the house, right? Or the blueberries,
you've heard the term house poor.
Exactly.
So that's where you're just working to make the mortgage payments, and there's no money left over to do fun things like go to a restaurant or take a trip or get extra clothing or whatever you want to do. So I think there's kind of the top level that you're approved for, but you have to take that into account and say, what else do I want to do and how much am I comfortable spending? And then look at that, and then sort of set your limits on how much you're going to spend on a house based on where you feel comfortable.
Yeah,
I think it makes a lot of sense to do it that way.
And just so everybody knows too, the reason we go through this process before is because it actually makes you stronger and more credible for when you do put in an offer, right? Because we're all very aware of the finance condition that goes in. If you haven't bought a home, there's pretty basic standard conditions, the home inspection, the financing condition, maybe a stat certificate review if you're buying a condo. But having that luxury of doing your due diligence beforehand maybe sometimes puts you in a better position.
Well, absolutely. So the financing conditions, usually 5 days, and it will take longer than 5 days to get pre-approved. You won't have enough time to do that, and that offer will probably just go by the wayside. So for sure, having it done in advance helps, and it also helps so you can decide what price range you're looking in. So if you're pre-approved up to $900,000, it does not make any sense to look at houses for 1.2 because you won't be able to buy them.
Well, and you fall exactly like it's a waste of everybody's time. In the sense that you're going to fall in love with something that wasn't realistic from the get-go.
Right. And so if you're pre-approved and you have a financing condition, there's a couple things that it does, but one of the foremost things is you're able to go to the listing agent and to the sellers and say, hey, I'm pre-approved for this home. I'm a qualified, credible buyer. That gives the sellers confidence that, hey, this offer is a good offer because the buyers who they don't know are qualified and can afford to purchase the home.
And you saying that 900,000, example as a threshold too, it sometimes gives you the luxury, not everybody, and we're not encouraging this by any means, but let's say you are buying something at the 800K threshold and you have a lot more wiggle room and you're not concerned about maybe the appraisal coming in a little bit less if the bank, what that means is if the bank, you buy it for 9, the bank thinks it's 850, you got to make up that difference, right? It's not saying you're not going to, get the mortgage. It's saying that if you want to close on this home, you need to have that extra funds or change the ratios.
That's right. And so that's one of the reasons we'd be still using a financing condition, even though you're pre-approved.
Correct.
It makes sense to put a financing condition in on an offer so that the bank can specifically look at that particular property and say, okay, we said we'd lend you, let's say $900,000, but, and if we think the house is worth $900 and that's what you paid, great. If we think it's worth $850, the bank does, then there's a shortcoming there and you have to make up the $50,000, and that could be just through a larger deposit or down payment, right?
And that's what I was saying too at the beginning of that is like, if you have that, you've done your due diligence beforehand and you understand that threshold, you may feel confident, or if you're in multiple offers, removing that financing condition because you've already done all these steps. So it puts you in a better position and knowing exactly what those numbers look like. Not just from, hey, am I going to get qualified by a lender, but okay, if I'm spending $800,000 and this is what my mortgage looks like, this is what my property tax looks like, here's what I pay on a monthly basis. You've done your homework and you can maybe have that luxury of removing it to get you that home versus somebody that had to keep it in.
Right, absolutely.
Okay, sweet. So we talked about, we haven't actually talked about the difference between variable and fixed rates. You want to chat about that at all? Or
so a fixed rate is simply that the rate is fixed for a period of time.
Yeah.
So you and the bank make an agreement. You're going to pay X interest rate for X number of years. Simply that.
And variable follows prime.
Variable follows prime, which the Bank of Canada sets the prime rate. And if the prime rate goes up, you're going to pay more interest. If the prime rate goes down, you'll pay less for a fixed period of time again.
Exactly. And generally speaking, at least what I'm seeing right now, it seems like a lot of people are going that kind of 3-year mark for both variable and fixed is what I'm noticing. Not saying I'm a mortgage expert by any means, but just thought, it's good to share what people are doing, at least from my circle of clients.
I think, it's kind of hedging, right? So if you think the rates are going to go up,
correct,
and you've got a fixed rate and you think, the chances are rates are going to be higher in a year, 2, 3 years, and maybe it makes sense to go fixed. If you think they're going to go lower, maybe it makes sense to go variable, but you have to speak to a mortgage professional.
And how you're going to sleep at night too, is there's a luxury of knowing what your payment's going to be every single time, which is the fixed, and the variable follows, Bank of Canada, which I think is important to note too, because last year, right, everyone was like tracking Bank of Canada. And I think people forget that it's the 5-year bond yield that is fixed, and variable is the Bank of Canada rate. So anytime they were dropping rates, people were just assuming like, oh, fixed rates are going to be dropping. Not necessarily. And you having that ebbs and flows, like my first mortgage was variable because I felt like I didn't have kids at the time. Our job was, say, secure, and we had a good understanding of what that looked like. So we felt maybe being a little more risky or risk averse. Is that the right word there, Gord? Made sense. But now with kids, like the last 2 times I've gone fixed because we want that stability. And I think a lot of...
And for budgeting purposes, right?
And budgeting purposes.
Spending this exactly per month. This is what I need to budget. So it makes sense to do it in that case.
And the spread too is closed a lot, where it was a big spread between the difference and you could really... high risk, high reward, but now it's I don't know. I personally I'm
rates
leading the
aren't
fix right
changing
now.
as much as they did,
Exactly.
like, back in the day, Trevor.
Back in the day. Oh, dear, 18%, Gord.
18%. We had interest rates at 18% back in the 80s. It was,
on a $200,000 mortgage, though.
or less.
Yeah, or less.
Still, it's 18%.
Yeah, I know.
It's a lot of money.
I know. Back then, too.
With Canadian mortgages, which we haven't talked about, but the interest gets paid first. So when you have a mortgage payment, your first mortgage
Correct.
payment, so you mentioned
principal and interest.
$5,000. Let's say your first payment's $5,000. Probably $4,995 of that goes towards interest.
Not that
$5
much,
something.
Yeah,
it's
no, it
really
is.
High
Yeah,
it comes off
100%.
Yeah, so that you pay the interest first in a Canadian mortgage, which it's interesting to think about, because if you're paying, you make payments for a year, think, oh, great, I've paid off all this money. How much is off my principal? And you look at it and say, well, it's not that much. A lot of it has been paid in interest, though.
And that's a good segue too for amortization, right? You have 20, 25, 30 years and qualifying for that. So a lot of people are going, maybe they want that forever home and they have to stretch it a little bit, and they go to the 30-year AM, and that makes their payment a little bit less. But to your point, you're paying a lot more interest up front, right? And your point of understanding that you're in for a fixed term, it would take you 30 years to pay off your mortgage if you stayed in that specific.
Right. And that's the difference between the
Exactly.
term of the mortgage and
Correct.
the amortization period. So the amortization period is exactly as you described, like how long it would take you to pay off that mortgage completely. Mm-hmm. And then the term is how long you're locked in for.
Perfect. And then you could do lump sum payments if you want to.
Some mortgage, yeah. But again, like for those kinds of things, you need to talk to a mortgage professional, because all of the products that they have out there are different.
It'd be cool if we could have it flash on screen right now and be like, we're not mortgage brokers. But as realtors, I feel like we are the first line sometimes too, in that the client or new individual that is deciding whether they want to work with us or not are asking these questions, right? So being informed and understanding things is really important.
It's so important. And like at the end of the day, you're borrowing money. Money's a commodity. So where you borrow it from, like you're getting money wherever you go to. What I think the difference is when you get really good advice. If you go to a mortgage broker, a mortgage professional that can help you plan and really explain to you what your options are, that's where the value is.
Well, and you hit the nail on the head at the beginning of the episode, where it's like in school you don't learn about mortgages in general, but even us, like the amount of things you can do with a mortgage is wild. Mm-hmm. You can build out so many different scenarios. They're all like, we're doing this high overview, but there's a lot of stuff that we could get into, even home equity line of credits and things like that. Exactly.
It's huge. Yeah, it's huge in the States, and it's becoming more and more popular here. That's where you take equity out of your home. So basically you own the home.
We call it a HELOC here, right?
Right, yeah. And so you basically take a loan against the value of your house. So you get cash, and then at the end of the day, when you sell your house, you get less for the house because you've already taken that money out.
But it's a great product, because I'm just going to give real life right now. We actually just did a HELOC. We're going to hopefully be adding a second story at some point in time in the next 3-ish years. And it's an amazing product because now we don't need to touch cash. We don't need to touch our finances or portfolio of things. We can just borrow from the equity in our home, pay only interest. And even to your point, even if I don't want to even pay it back for the next 20 some years, maybe that's a stupid decision, but I'm just using it as an example. It's there, and I'm saving in other ways too, and I still get what I need from utilizing my equity, right?
And a lot of people are using it when they retire. So they plan to stay in their home for a long time. Some people make the choice to downsize and buy a quite a bit smaller home, use that equity, reinvest it. And other times it's, I want to stay where I am. I love living here. And so they, get a reverse mortgage, and then they're drawing from that. So
retirement, instead of, taking dividends, you're just taking little pieces here and there, and you're paying peanuts.
Absolutely.
At least right now. Prime is what, 4.35?
Yeah.
That's pretty good.
It's really good, especially when you consider back. And, the race that we saw, I mean, it's a long time ago, and it hasn't been like that for a while, but, it's... to borrow money, I think it's still reasonable. Reasonable.
If you need $500,000 just on like 5%, you're that's $25,000, which is that's cash ready to go. It's kind of scary, Gord. Yeah. Okay, so what else do we have? Insured mortgages versus uninsured. That's a big topic.
And it's changed recently.
It has.
So an insured mortgage is if you don't have enough of a down payment, then the lender wants to insure the mortgage in case you default on it.
Correct. And what did that threshold change to?
Well, that's a very good question. It changed to $1.5 million.
Oh, yeah. Eh?
From $1 million.
So to give an example, right? The first 500K was you have to put 5% down.
You have to put 5%.
And then it used to go from 500 to 999 was 10%, and everything over $1 million was instantly 20% down. That threshold now increased from $1 million to 1.5. You could put that 10% and have an insured mortgage. Now, keep in mind, right? This is a product that is really good if you don't have that down payment, but you maybe have high income because
that's right. So
you're going to have a huge mortgage.
Cash to come up with the 20% down payment.
Correct. And
what if it's over 1.5?
That would be the 20% interval, which we were talking about. And keep in mind, we have to say too, it's for first-time buyers or new homes. So if you are upgrading from a condo or a townhouse to that forever home, you are in that threshold of the 20% down minimum. Right. It's only when you're first time and new build for the insured element. Now, did we say from insured how it gets built in with CMHC and Genworth? Go ahead. You want to take that one or what?
You talk about it.
You want me to talk about it? Okay, so
you're more knowledgeable on the insured side.
Why? Because I've done it. Yeah. So with the insured mortgage, so closing costs, right? In general, usually you have your lawyer fees and your land transfer tax. Toronto, you pay provincial and municipal.
And that's on the purchaser side. So when you purchase, you have land transfer tax. When you sell, the purchaser pays the land transfer
Correct.
tax.
And those are the reason I'm saying those costs specifically is because those are out-of-pocket costs.
And they're the most expensive.
And the most
expensive. You'll still have moving costs.
Yeah,
hiring a mover, buying boxes.
Correct.
Stuff.
Those are sunk. You're going to have to do that regardless.
Yeah.
But with an insured mortgage, so CMHC is the biggest. And let's say you are putting down that 10%, like the examples we just gave, that will be there will be a fee, and it inclines kind of like your tax bracket. So I don't have it in front of me. We probably should have done that to know the exact stats, but essentially, let's say 400 is 0.5 and 1 million is 1, et cetera, et cetera. The percentage interval of what you would owe that gets added on to your mortgage. Now that's important to note because it's built in to your payments. So you are not spending additional out-of-pocket money, but your mortgage is higher because it's probably going to add, let's say, another 20, 25K on it, right?
And that will affect your pre-approval amount.
Correct.
So if you have a lower down payment because you need to be insured, you will probably be pre-approved for a lower dollar amount for the purchase price.
Perfect. And usually the system, in my opinion, is backwards, where with an insured mortgage, you usually get a better rate, notoriously, than the uninsured product, because I guess, in the eyes of the lender or the bank, it's going to take you longer, right? From the insured standpoint. So let's give them a better rate and have them hang around longer. But the uninsured element is when you put the 20% down. So you do not have that additional fee that is built in your mortgage. So you have to put minimum 20% down. And that also does change depending on how expensive the house is, right? It's not just like 1.5 to 3 million, you only have to put 20% down. Right. There's a lot of different ratios and making sure how they qualify you.
And again, that's when speaking to a mortgage professional and looking at different mortgage products is.
Gord, I don't know. Are we mortgage professionals after this?
Yeah,
we're not. I'm teasing.
We sell houses.
Yeah, we sell houses. We're giving that high overview.
Yeah, it's a high overview. Just kind of a snapshot into what is a pre-approval? What is it for? How does it help you if you're purchasing a home? And what are other important things to talk or to think about? For example, we talked about having a down payment. What kind of a down payment you need?
We actually didn't talk about down payments.
Well, we did. We talked about the amount though.
The 5%,
the 5%, 10%, 20%
deposit, and everything.
We didn't talk about deposit. That's something else we could talk about, but which is part of your down payment.
Yeah.
But just overall, like from a high level, things that you need to consider. What a pre-approval is. How does it help you when you're purchasing? And
I think the general message, at least for me when I'm talking to my clients, is it is extremely important to get pre-approved beforehand, because
Well, otherwise you don't know what you can afford. And
Out of the gate.
Out of the gate. And going through that pre-approval process, it forces you to really do a budget and to look very carefully at, like, what is your income? What is your debt? How much can you afford? And then where, if maybe those things don't line up for sort of what you can afford and what you want, you can have a hard look at where you're spending, and it helps you do that, because you have to analyze all that, and you can maybe cut back on, some things that maybe you're spending money on that you didn't need to, or didn't, you'd rather put towards a house.
Okay, and before we get into our dad jokes, are we forgetting anything, Gord? Let's.
Well, you touched briefly on deposit. So when you purchase a house, within 24 hours of purchasing, you have to put a deposit down. And deposit is generally 5% of the cost of the house or the property.
Certified funds. You need that liquid.
Yeah, you can't, and it becomes part of your down payment. So it comes. So if you buy, let's just say, a house for $1 million, and you put down 5% as a deposit, you would be putting down $50,000, and that would come off the purchase price. So at the end of the day, when the house closes, you would owe $950,000 still.
Correct.
So, yeah.
Well, and plus the remaining down payment.
Plus the remaining down payment.
Yeah.
So the other 150 if you put down 20%.
Correct.
Yeah, I think that's it in a nutshell. That's it.
I just realized,
a lot
too,
of information.
I think I've had this. I wonder if this is going to show up. My lunch.
The ketchup on your shirt? No, you can hardly see it.
I kept seeing your eyes. I'm like, what's he looking at? But
just the ketchup. Don't worry.
Just the ketchup. No. Well, I guess before we leave, what dad joke you got?
What's something in the news I heard yesterday? Did you hear that the archaeologists discovered a king from ancient times that was only 12 inches tall?
No.
He was an excellent king, but a terrible ruler.
Which one did I? What was I going to say today? Because I don't know if my raunchy ones landed last time. Yeah. So did you hear about the new restaurant on the moon?
No, I did not.
Great food, no atmosphere though. At least we think they're funny, right?
We did it. Awesome. Good
All
job.
right, Gordo. Another one in the books. Yeah.